All right, guys. Well, happy President's Day. Looks like we're all suffering working here today. Normal size crowd, so the job doesn't stop for those of us in the real estate and mortgage business. Um, so, actually, got a lot of information to share today. We had some market movement last week. Was pretty positive for mortgage bonds, so we'll share that. I've got some charts and graphs to share. We're going to talk about some events we have coming up. We've got a cool loan program we're going to share, and that should take us 30 minutes. So, with that, guys, happy Monday. I'm going to share my screen and we will get this show on the road. Okay, so we had two big pieces of news last week that were market moving. Hey, Wilton, can you see my screen? Do give me a thumbs up if you can see it good.
Yes,
Cool.
sir.
Okay. All right. Awesome. So we had a jobs report on Wednesday, and the jobs report is typically very market moving. Um, and many of you have been, on these calls with us for a long time. So a good jobs report that meets expectations. You guys give me an answer. Does that typically increase or decrease mortgage rates? So jobs report comes in hotter than expectations. What does that typically do?
Increase.
Increase or decrease rates?
Increase.
Increase.
Okay, increase rates, right? And so that was right here, this red line on Wednesday, the 11th. Okay, got a little bit of a surprise to the upside. Jobs report came in hotter than expectations. Well, then why did Thursday the bond market have a big rally? Okay. Um, does anyone think the market, and just say, yes or no, does the market trust the jobs report numbers or not? What do you guys think?
No.
Yes or no? Okay, a pretty hard no, right, Jen Fanning? So what happened last week was the jobs report came in slightly better than expectations. Not a huge, kind of miss or positive to the upside, but a little bit better than expectations. It came with the typical slight downward revisions of prior months. And so the initial reaction was a little bit of a bond market sell-off, this red line here. The market sold off, um, bond pricing went down, yields went up. Thursday, it completely flipped. And I think that was after the market said, well, wait a minute, we haven't been trusting these jobs reports for years. They've been inaccurate. There's been multiple revisions downward in future months, and that's likely to happen again. And so had a nice little rally. And then we got another good piece of news on Friday. The CPI, or the Consumer Price Index, that was a downside miss, came in better than expectations. Really good news on inflation. The year over year headline number was 2.4%. That's the lowest inflation number in 8 months. Okay. 8 months ago, what were we in the middle of? That was kind of the early, tariff talk, right? Like April, May, June last year. Um, and so nice positive number on inflation. The market really liked that. And so Thursday's kind of rebound, continued into Friday. Market's closed today, so there's nothing happening right now. We have this black line here above us, and if we go back for the past 6 months, you can see we've kind of touched that a couple lines in January. We got above it a little bit January 9th. We got near it last September. If we go back for a full 12 months, bond pricing today is about as good as it's been for the last 12 months. If we go back to the last 24, we briefly touched it at the end of. Ooh, can you guys see my screen now? I had a little glitch on my.
No.
And, we just got you, Mike.
What's that, Jimmy?
Just got you. We can see you.
All
So,
right. Yeah, sorry. No, my dual monitors just glitched on me a little bit. So give me a second here. Let me
They're singled.
get this back up. Yeah, how am I going to survive working off one monitor? It's just like the 90s. All right, we'll get that back up here. And then of course, once I do, then it'll probably like go back to three. All right, let's see if we can get this back up here. All right, sorry about that, guys. Just gonna unplug them so they don't get glitchy, and then we should be back up. Okay, must have had an internet surge because I had to log back in too. All right, let's try that now. So, Jimmy, let me know if you can get me back up on my old school one monitor. There we go. I think we're good.
Yeah, MBS highway.
Perfect. Okay. So we are, really about if we go back, the last 2 years, this kind of line we're at right now, bond pricing, as good as it's been really going back 2 years. And really the last time we saw that was like the fall of 2024, right? And that was that really positive bond market in 2024, right before the Fed's premature cut when inflation spiked. And so we've been kind of dancing. I'll just go back to a shorter window here, last 3 months, kind of dancing along this a little bit. We'll need continued positive news to bust through here. But certainly don't see any risk to the downside. Doesn't seem like there's anything economically that we're going to hear that's going to push bond prices lower and yields higher. Um, the 10-year treasury, and so we've talked about like mortgage rates following the 10-year treasury, and mortgage rates are typically a spread above the 10-year treasury. The 10-year treasury has also gone down significantly, 4.05%. That's the lowest that's been in quite some time. So some really positive bond-friendly news last week. Um, on the calendar this week, the really big event we have is the PCE, the personal consumption expenditure. That's the Fed's favorite measure of inflation. So if we pull up the economic calendar of the week, we get PCE on Friday. So not a lot of news the next 2 or 3 days. Friday is the big day where we get PCE. Okay, so some positive bond friendly news. Let me stop sharing my screen here. Okay. All right. So I'm going to bring up a couple of charts and graphs for you guys here because there's a few things that feel like we have some kind of tailwinds behind us right now from a bigger picture scale. We've talked on this call a bunch about government debt and government deficits and the amount of money that the government is spending is a negative because we've got some supply and demand issues. If the government is spending $1 trillion a year more than it brings in, and it's flooding the market with supply of bonds, mortgage bonds or treasury bonds, that will cause prices to drop, just like if a flood of houses hit the market, which would cause home prices to drop, right? Supply and demand. So let me share my screen. I've got two graphs here I wanted to show you guys, which are kind of interesting. So the first is kind of government spending, government outlays, and this is not something we're going to celebrate a lot because we still are running a ridiculous deficit, but the deficit seems to be getting bigger. Okay, so when we look at last week's jobs report, um, does anyone know, or can anybody tell me what sectors of the economy have been the most positive for job growth? Does anybody know? Okay. Healthcare is a big
Here in
one.
government.
Okay. Right. And then what has been the sector of the economy that's been maybe the weakest or seen the most job losses?
Small business.
Okay. That's government, Jimmy. Okay. So if you think about like Trump and Doge and cutting um, government spending has come down. The deficit is getting better. Um, the deficit is getting better due to less government spending, but some of that reduction in government spending is government employment. Okay. And while on one hand, it's a real positive that the government's spending less, we probably have too many people employed by the government, right? You could probably cut a lot of staff from the government. You could probably cut a lot of employment related expenses from the government. That would help us get not close to a balanced budget, but at least less of a deficit. But at the same time, those are people, right? Some people on this call probably have a family member that, works for some government entity. And when the government shrinks and they cut jobs, while it's good on one hand from a spending standpoint, that's going to increase unemployment, right? And so I think you have two things that are going to push unemployment higher, which is why I think you're going to continue to see weak jobs numbers. One is AI, which we've talked about a lot, right? Just creating efficiencies. Companies don't need as many people. And then on the public sector, the government is shrinking. And so you're seeing a lot of government job cuts. You're seeing a lot of growth in like healthcare in particular sector, but that's why you're seeing pretty flat numbers from an employment standpoint. But if we look at, and this is just kind of an annualized number here, but the annualized number of the deficit is down from a trillion a year down to 697 billion. Again, not something that we want to celebrate too much about because we're still running a massive, massive deficit, but it's getting better. And if the government is spending less, if they're borrowing less, if they're putting less treasuries on the market, that helps the treasury market and the bond market overall from a supply and demand standpoint. If we're running lower deficits, if they're putting less treasuries in the market, less supply, more demand, bond prices should go up, yields or rates should go down. So we've talked a lot over the past couple of years that these massive deficits are kind of a headwind that prevent rates from going lower. If we're starting to see some improvement in the deficit, that slowly becomes a tailwind, which can help push rates down. Um, at the same time, and this is just from kind of my favorite, feed on X or Twitter, Kobe Escalator, I reference this one a lot. Um, you're seeing a lot of talk of treasury holdings at financial institutions that are surging. More and more companies and countries are buying bonds, treasury and mortgage bonds. And you can just see just from the snapshot I grabbed, like, primary dealer holdings are up. Year over year, they're up. And so that's a positive. And so you have less supply coming into the market, you have more demand coming. If that happened in real estate, think about real estate. Less homes hit the market and more buyers come in the market. What's that do to prices? That causes them to go up. And so in the bond market, less supply, more demand, prices go up, yields or rates go down. So I think we've got some good news last week. We're probably going to get good news on the PCE inflation report this Friday. Then you have some kind of bigger macro factors that I think are helping us as well. So overall, certainly some positive movement in the bond market that we expect. Um, how does that moving interest rates lower affect our customers' estimated monthly payments? And this is what I wanted to really kind of walk you guys through and share today. As always, Jimmy, can you guys hear me okay?
Yeah, you're good.
Okay, I'm still a little bit glitchy here with my one monitor, so bear with me. But when my computer stops glitching, here we go. Um, what the main thing I want to share with you guys today is, so what does that mean to our customers? Like if interest rates are coming down, and I think prices have softened a little bit in most markets, how does that affect affordability? How does that affect our customers, right? That's what they care about. And so we put this chart together, and if you guys want a copy of this, just message whoever you work with on our team. We'll get this in your hands. So top line, I've got sale prices or loan amounts really. On the left, I've got interest rates, and then this big section here is monthly payment. And so here's a couple examples I wanted to share. So let's say a year ago, and within the last year, there's been times when rates have pushed up close to 7%. Um, if you had a $450,000 house at 7%, your monthly payment would be around $2,900 a month. I don't know if could that same house sell for cheaper today? Probably. Is it 400? Maybe not. But let's say you go from 7% and rates are down to 6%, so we've seen a drop in rates of about a point. How does that affect your monthly payment? It's about $300 a month. Okay. So for the same house, you could have a similar home, same price, lower rates, $300 a month less payment. Okay, that's certainly an affordability improvement. Um, how much do you think you could increase your sale price by for the same $300 a month? Okay, you can increase your sale price by about $50,000, right? This same $2,900 payment at a 7% rate. Now you can have that same payment at a 6% rate on a $500,000 house. And so if we're looking for like communication to our customers or social media content or things like that, I would be putting out things that say, with rates dropping, you can buy a house that's potentially $50,000 more expensive for the same payment as you could a year ago. I think that's a really powerful message that we can share. And we'll use some different examples here. Let's use the $300,000 range. So $300,000 at 7% is about $2,000. Um, you'd have to get to around 5.75 to be able to go from 3 to 350. And so, but for $100 a month, you could go from 22,000 to 2,100, 300 to 350. So, either way, I think the average buyer has probably seen their purchasing power increase by about $50,000 for a similar payment. So I think that's something that's powerful that we can share. Again, if you guys want this chart, just message whoever you work with on our team. Everybody has access to this. But I think affordability is improving. If you start to see rates get into the fives, which we're certainly seeing that on government loans and on conventional, we're starting to see it more and more. It'll be interesting to see when the market opens tomorrow. But I think we're going to start seeing more and more people getting into the fives right now. That psychological barrier, I think, also helps. So the psychological barrier of rates being below 6, feeling like you get a good deal, the actual math showing the difference in payment at the same price or the same payment at a higher price. And then I think most buyers are starting to come around to the fact that there are deals to be had, right? You're seeing price reductions. Like when people follow properties on Realtor, Zillow, Trulio, wherever, like they're following the same properties and seeing price reductions. And so I think more and more buyers are feeling like they're getting a good deal that they probably didn't feel that way a couple years ago. So I think those are all three factors that we can talk about. And I think it's a really big selling point to say you can buy the same, a $50,000 more expensive house for the same payment than you could a year ago when rates were a point higher. I think that's a clean, easy message that people will understand and know will resonate. So anyway, just get with us if you guys want a copy of this chart. Um, the other chart I've got to share today is we've talked about for a while now. There's kind of like two economies going on. There's um, higher income, a little bit older, a little bit more experienced, you know, um, in their careers. They're having less, being less impacted than those that are younger, less experienced, less income. Um, and it really holds true when you look at the types of debt that people have. Okay. So let's take your move up buyer, right? 35 to 50 years old, let's say. Um, those people tend to have more mortgage debt. Okay, so this is the yellow line. So let's look at the delinquency rates here of mortgage debt. And this goes back to 2003. So you can see it spiked during the financial crisis. It came down significantly for many, many years, kind of on a steady pace. It basically went to zero during COVID. And even now, it's barely increased, right? 0.92%. Okay. Home equity debt. This is the purple line, kind of similar trend, not to the same degree as mortgages, went, lower, not quite as low as mortgages, but today we're at 0.82%. And so you think of your move up buyer or even like your retirees downsizing, what kind of debt do they have? They typically have mortgage debt. Okay. What's the second type of debt that they might have? They might have auto debt. Okay. And so auto is this green line, similar trend, increased during the financial crisis, came down. Interesting how it kind of slowly increased from like 2016 to 2019, dipped a little bit during COVID, back up now. 5.1% is concerning. That's about as high as it's been since 2008. So that's I think a sign that's a symptom of unemployment going up. Um, but now let's look at like younger people, okay? People like that are first-time home buyers that don't have as much income, aren't as established. What kind of debt do they have? Student loans, right? And so look at student loans. Historically, kind of a high default rate, 5 to 10%. It kind of hovered around 10%. Now, this is a little bit misleading because a lot of people with student loans, like it counts people that are in forbearance or that like couldn't afford the payment, put it in forbearance after a late payment. So student loans are always going to have a higher number because the federal government doesn't file a collection. Like on a car, if you don't pay your car loan, you get repoed. That loan's no longer delinquent because the dealer, the finance company took the car back, right? There's no repos of a student loan. You can't file bankruptcy and get rid of a student loan. The only way you get rid of it is you pay it off or you die, right? Like that's the only ways to get rid of a student loan. So they're always going to have higher default rates because you can't go bankrupt and file bankruptcy with a student loan. But here's kind of the mistake that I think the government made is, right, this kind of student loan forbearance, you don't have to make your payment for a couple years. And then that number surged from 0 to 10% in the last year. And we all saw that in our business last spring when the student loan forbearance program ended and those delinquency rates shot up. But that's certainly concerning. So 10% of your potential first home buyers have a delinquent student loan, which probably makes it where they're not eligible for financing because they either have a delinquent federal debt or their credit got wrecked. Um, and then the other concerning one is credit cards. Again, not secured by any asset, always going to have a higher default rate. That spiked a little bit. And so if you think about like, and we see all the numbers. So I can just tell you that most first-time home buyers we work with are stretched pretty thin. Um, whether that's their income hasn't increased a lot in the last couple of years, cost of living's gone up, they've accumulated some debt, auto, student loan, credit card, they're feeling a pinch, and you can see it in default rates. And so this is just kind of another statistic that tells us there's really two types of customers right now, and it's the economic bracket that they're in. Some people are very secure, some people are really stretched in. And I think you'll see these delinquency rates probably continue to rise a little bit before they level off later this year. Um, Interest rates coming down certainly would help the credit card numbers. It would help the auto numbers, and it would probably
Yeah.
help the student loan numbers as well. Okay, so that's all the charts and graphs I've got. Again, any of these that you guys would like a copy of, message whoever you work with on our team, we'll get them in your hands. And then just the last couple things I've got for you guys today. We've got a couple events upcoming. I know we've talked about them 2 or 3 times here. I just want to make sure everyone's kind of aware. If you're in Central Florida, we've got a few things upcoming. And if you haven't received an invite, just message us. We'll get them in your hands. We're doing a headshot event tomorrow for anyone in Central Florida. You probably got an invite for that. It's around lunchtime tomorrow. Professional photographer coming in to take headshots. Anyone coming to the Orlando Tom Ferry event, it's this Thursday. RSVPs, it's sold out. So hopefully you've RSVP'd already. And we're doing a happy hour after the event that night at Bar Louie, which is right by the airport. And for those of you in South Florida, the Miami event is coming up, and we'll kind of have similar events planned around that. So I think we're a couple weeks out from the Miami Tom Ferry event. And then if you're in Central Florida, next week we are doing a class on the buy before you sell program. So if you want to make a non-contingent offer, we'll talk about bridge loans and how to qualify carrying 2 houses and all of that. So that's in person next Tuesday. Probably get some invites on that from this as well. And then to wrap it up, I want to tell you guys about a loan program. So I'm going to ask a question here and let you guys answer, and then we're going to talk about a specific loan program. So conventional loan, okay. How much money do I need to put down to avoid mortgage insurance? Okay. How much money do I need to put down to avoid mortgage insurance? Dave, you can't answer.
I'm not answering.
I see that grin on your face. Okay, how much money do you come on? Someone can answer. Don't be scared. Okay. How much money do I have to put down to avoid PMI? Okay, 20%, 20%. Okay, depends. Okay, so let me walk you guys through this. Okay, there's 3 kinds of PMI. Okay. The answer is 20%. Okay, you need 20% down to avoid PMI. But there's 3 ways you can pay PMI. You can pay it monthly, which is the traditional manner. Okay, so that's the standard monthly mortgage insurance. That percentage goes up the less you put down. So putting down 15%, PMI is pretty cheap. 20%, a little bit more expensive. I mean, 10%. 5%, a little bit more expensive. 3%, a little bit more expensive. So the less money down, the more it costs you as a percentage. You can also pay PMI as an upfront fee. I think that's what Jen Fanning was talking about. You can pay a flat lump sum fee, and that buys out the PMI. We're not really big fans of that because we feel like you're probably paying more money in the lump sum than you would pay monthly to pay it on a monthly basis. The third way is you can do what's called LPMI or lender paid PMI. And that's typically where the lender increases your rate and kind of builds the PMI into the rate. Okay. Now, Corey answered 15%. Okay. And so the reason why Corey answered 15% is because we have a program called Buy Buy PMI. It's a 15% down loan, conventional with no mortgage insurance. And there's two criteria. You have to have a 740 FICO and you have to have a low 43 debt to income ratio. Okay. Now, why can we do that? All right. So if I was to price PMI out for someone putting 15% down with a 43 DTI and a 740 FICO, it's incredibly cheap, like 0.12%. So we created a program where we basically eat that 0.12%. The rate doesn't get bumped, it's not built in. We just cover the cost. It's really cheap. Um, I'm going to give you guys two specific examples of how this helped us. One, I think maybe win a deal, and two, save a deal. Okay. So we had a closing, or it hasn't closed yet, but we had a transaction that we were working on, and there was an escalation clause. Okay. So let's say the sale price was 500,000 and there was an escalation clause to 510. Okay. Um, and you all may have had this happen before, but the appraiser didn't see the escalation clause. Even though it was put like on top, the appraiser didn't see the escalation clause. Okay. So the appraiser thought that the house was selling for 500,000. What do you all think the appraiser appraised the house for?
500.
Okay, 500,000, right? Because that was the target. Um, and it was an appraiser who's great. We've worked with forever. It appraised for 500,000, right? The problem is we had a purchase price of 510 and the appraiser didn't see it. So, Mac, I saw you, same thing happened to you. So thankfully, here's what happened. Okay. Appraiser couldn't change the price. Like we couldn't appeal the value. We tried, but he just, if he knew it was 510, like two clicks of buttons on adjustments of his comps and it appraises for 510 and hits the target, right? Um, so this client was putting 20% down. All we did was change it from a 20% down conventional to an 82% loan to value, buy PMI, rates the same, payments the same, no mortgage insurance, problem solved. Okay. So pretty easy fix. So that was a deal saver. Dave was snickering a little bit when I asked about the down payment because we had a buyer that we just got a contract on that like 20% was kind of their number. They really wanted to get some closing costs from the seller, and the payment's a little bit more than what they were budgeting. And so a 2-1 buy down, and that program is not like a magic bullet, guys. Like I don't think any of us think it is, but for someone that expects their income to increase, a 2-1 buy down is kind of a cool program. And so lower payment for year 1 and 2. And that was exactly what these buyers wanted. They wanted some payment relief in the first 2 years until their incomes bumped up a little bit and they were comfortable with what that payment might be, years three and beyond. Um, Not a bad program as an aside. If you have a property non-homesteaded that's got really high taxes and you know the taxes are going to drop, a 2-1 buy down can kind of help with some payment relief until the taxes can change. Uh, could work for move-up buyers that have a lot of homestead portability, that their taxes will go down. Another way to think of that. But anyway, we couldn't get commissions, closing cost, and 2-1 buy down all paid by the seller. It just wasn't going to work. And so what we decided to do was rather than doing a 20% down loan, we're doing like an 18% down loan or a 17% down loan. The buyer's bringing less cash to close to stay within their budget, and we can get, so we're not getting the full like 5% credit from the seller for the closing cost and the buy down. So all we did was we just lowered the down payment, so the buyer's out of pocket cash worked. And so we're doing an 18% down, no mortgage insurance, 2-1 buy down. And those kind of moving targets is what made the numbers work for the seller on their net, for the buyer on their payment, and the buyer from an out-of-pocket cash standpoint. So keep that buy PMI program in mind, guys. I think a lot of people get in their heads that they need 20% down, but sometimes it stretches them thin that they can't do 20% and closing cost. And so that program could be 17%, right? Because we don't need seller paid closing cost for the right person. So anyway, just something to keep in mind. And I don't know how many of these that we do, but I feel like we've been in a market where it's not as hard to get seller paid closing costs as it had been prior years because there haven't been a lot of buyers. I think as the spring market heats up, rates come down a little bit, buyers come back in the market probably heats up and there's probably less opportunity to get seller paid closing cost. And if we can't get seller paid closing cost, then maybe we can reduce the down payment a little bit, not hit them with PMI, and make the numbers work from a payment standpoint, seller net, buyers monthly, buyers out of pocket. So just something to think about. So it's a pretty cool program. So if you guys have someone that might fit in that bucket, let us know. Um, all right, guys, it's 10:33. We'll let you guys run. Have a great day. Have a great week. We appreciate you jumping on. Watch Friday morning, PCE, big market mover, a good number. Maybe that's the catalyst that pushes us above that support line that's kind of, kept rates from getting significantly below 6. So Friday morning, 8:30 is a big one. And we will see you guys next Monday. Thanks, everybody.
Thanks.